a trade, right? So I'm gonna break it down. So first thing I do, I'm gonna have to put you away because you don't stop. But first thing I do is obviously I look at larger time frames. I'm gonna show you guys how simple it should be, right? So this is a weekly time frame. I'm gonna turn the music down actually because I don't want to get copyrighted on YouTube when I put it up. But this is a weekly time frame. I'll get to y'all's questions in a bit. So if y'all have any questions while I'm explaining things, go ahead and ask them, and then I'll go look through them once I get done explaining something. But I'm gonna break it down, right? So you start on larger time frames. You want to find the overall structure of the market, right? So obviously here, late 2021, all the way through 2022, we were in a downtrend, right? What's a downtrend? This is like the basics, right? So you might have like a resistance. This is called a level here. It's just a point of interest where price continuously rejects or continues to bounce, right? I got money go hard. What makes it a resistance? What makes it a support? It's as simple as if price is under it, it's a resistance, right? If price breaks through it and then bounces off of it, it is now a support. So it's really just a level. The term, resistance or support depends on where price is compared to that level, right? So it's like there's resistance here, right? Previous highs. You always want to mark previous highs. That was a resistance before now, right? We rejected off that resistance and now we're above it. So now you can use it as a support, right? So you always want to use, oh shit, I'm not even showing my screen, bruh. All right, hold on. Rookie mistake. Is that better? Is that better? We'll make this smaller. All right, I'm gonna run it back. Yeah, I appreciate all the follows. If you're not following, go ahead and follow because I'm gonna be on this, giving a lot more classes. But look, this is a level here, right? Let me just show y'all where it was. This is a level here, right? A level is basically just where it's a point of interest where price continuously rejects and and bounces, right? So if I set a level there, this is where price is continuously resisting. What makes it a resistance or a support is if price is above or below. So if it's below the level, it's a resistance. If it breaks above, like it did up here, it is now support level. That's the term resistance or support. But they're all levels, right? That's a level. That's the first basic thing that you have to know about trading is marking levels, highs and lows. Super easy. And then I'll once I get past like the basic stuff, this might be boring for some of you, but I promise you that once you understand the simplicity behind trading, it makes everything so much easier because you probably see all this and that, like fair value gaps, market structure shifts, break of structure, continuations, da da da. All these different terms are like blown up terms. Like they don't have to be that complicated. Like I said, like of course ICT, trading is super successful. Supply and demand is super successful. Price action is super successful. A lot of people argue and say, oh, like this or that. It really doesn't matter. The way I see it is like, I know this is probably a bad comparison or analogy, but I'm a Texas boy, right? So it's like if I have a pistol, which is supply and demand, but my target is, let's say like far as fuck, for example. How do I even line this up with trading? I don't know what the fuck I'm saying, but in my head it makes sense. So hear me out. Let me cook, right? Let me cook. But say for the day, you don't have supply or demand, right? But you might see an imbalance. It might be like a tight range, but you see an imbalance, right? Like a fair value gap. You could play that, ICT, or you could play supply and demand when it's there. The more you add to your arsenal, the more weapons you have and the more successful you're going to be, right? So it's like if something's long range, you can shoot that hoe. But if it's right next to you, I mean, you could use whatever you need. It's like it's there. A lot of people argue they have like they act like girls on the internet when it comes to trading, but it's all the same thing, bro. Like levels, You know, a lot of people call this liquidity. I just call it a level or a resistance level. It's the same thing. I promise you. It's not gonna hurt you dumbing it down and trying to make the hardest thing or hardest one of the hardest ways to make money as simple as possible. Like, why would you want to make it complicated for you to sound smart? Like, just trade the charts. Simple as that. But the next simple thing is uptrend and downtrend, right? Super simple. You have a high. This is an uptrend. You have a higher low. Higher high, higher low. What makes it a higher high? This high is higher than the previous high. This low is, or this low is higher than the previous low. This is an uptrend, right? Just makes higher highs, higher lows. Boom. What's a downtrend? It's the opposite. You have lows. I'll just do it there. You have lower highs, lower lows, lower highs, lower lows. Boom, whatever. So what happens when you go from an uptrend to a downtrend? This is called what a lot of people like to say market structure shift, break a structure. This is, you know, or you could just say this is a break of trend. You know, there's so many ways that you can say whatever. So let's make our own term. I'm gonna make I trade ICT, Papero. I want to learn yours. That's what I was just getting at, bro. It's like everything is the same thing. It all just has different terms. So let's create our own term. What should we call what people call market structure shift, or you know, a trend reversal, or what should we call it? I think we should I think we should call it, you know, if it goes from a downtrend to an uptrend, we should call it a hump up. And if it goes from an uptrend to a downtrend, it's going to be a hump down. So I'm going to call it hump down. This is a hump down. Right? When we go from an uptrend to a downtrend. That's what I call a hump down. It's all the same shit. It's really just, you know, the basics. It's super easy, right? You could call it whatever you want to. It doesn't matter. But this is what it looks like on the chart. I'm trolling, by the way. You know, like I'm just bullshitting. All this stuff like is legit, trust me. But like when it comes to the terms of it, it really doesn't matter what you call it. So yeah, this is a downtrend. Obviously, you see here, and then you go from making, you know, that's the downtrend. You go from making lower highs, lower lows, to not then making higher highs and lower highs. This is how you can predict, you know, or anticipate a trend reversal. And then as you can see here, we ended up breaking these previous highs. So we had a high there, high here, some highs there, kind of. That's when it started getting tight, breaking out. Boom. And then we ended up reversing off that level there, right? So it's all the same shit. Trend reversals, hump down, hump up, break a structure, market structure shift. I've heard it all, right? So that's the complete basics, and this is on the weekly time frame. So what I do, we're already approaching all-time highs, you know. So if you would have joined Decrypt, you know, a year ago, I know a lot of you guys probably just ran into me like today or these last few days or like last week or maybe this month, right? But you would have known the bottom and the top if you were here in 2021, 2022 of the market. Because it's not hard to tell when the market's going to start shifting, especially when it's moving sideways for like almost an entire year. That's how you know the market, you know, is like, you know, maybe we don't want to go down anymore. We don't have any more selling power. We're going to start making lower highs or higher lows and higher highs. So what I do is I mark previous highs. Boom. I'll use these as targets on larger time frames. So these are all our previous highs there that we're approaching. So once we, you know, once we broke out these highs, my next move was to target 431.93, right? So we're gonna, this is the weekly time frame, keep in mind, right? So it's gonna take time to reach there. It's gonna take time to get there, but eventually it will get there, right? So once we, you know, especially when you see something like that, candle close like that, you just go ahead and, so, you know, we're going to 431. We're going to see these previous highs. You want to use them as magnets, right? So obviously, get through. We break through. We break through that high. Break through that high. Okay, cool. Now we can use that level as a support pivot point. and start chasing 462. But once you have all these highs marked, now you could go into smaller time frames like the 1 day, and you can start anticipating 4 hour. You can start anticipating pivot points around these areas. Where a lot of people mess up is they try to fight the trend. You know, we start approaching these resistance levels or these levels up here, and they're like, you know what, I'm gonna start shorting. When we're uptrending, when we're making higher highs and higher lows, it's much more likely that you're gonna make profit playing the upside than you would the downside. Why would you fight the trend? You know, bias and ego is one hell of a thing when it comes to trading. You just have to accept what the market is giving you. You know, all last week, or really all like these last 3-4 months, I've been saying stop shorting, stop shorting, stop shorting, stop. I think since July, I just been saying stop shorting, hashtag stop shorting, stop shorting. Play calls, I promise you. That's because we're in an uptrend. How do you identify the trend? Like this, right? So I showed you guys that this is an uptrend, higher highs, higher lows, right? It's not perfect. This is a downtrend, lower highs, lower lows. Boom. And this is what it looks like on a chart. You have high, lows, lower highs, lower lows, lower highs, lower lows. And then eventually market starts breaking through those previous highs and signifying a reversal. This is an uptrend. Have a low, higher high, higher low, higher high, higher low, and then higher highs. Boom. That's what an uptrend looks like. It's obviously never going to look picture perfect. This market's not meant for you to make money. It's meant for them to, you know, take money from you. So it's never going to be like perfect. It's always going to be a lot harder. So I had these highs marked here. And another thing is I don't use my levels. Like I don't use these previous highs to take trades. I start looking for reversals around these areas, right? So like if I would have just placed calls at 431.91 0 DTEs because we're at this previous high, I would have got bagged. I would have been, you know, I probably would have made a little bit of money, but I would have got bagged for sure. Because it ended up coming lower, right? And then eventually it went higher. 0 DTE is 0 days till expiration. So with options, every contract has what is called the Greeks. You have theta, you have gamma, and you have delta. Delta is how much the underlying price of the contracts change per dollar of the stock. So if you buy, you know, say we're at 411 on spot, right? And the delta is like 50 cents on the contracts. For every dollar that, say you buy calls, for example, for every dollar that SPY moves up, that contract's going to change 50 cents. So if they're $1, or say they're 50 cents, and then it moves up $1, you buy $1 out the money, which is usually what you tend to have to do, or you should do. It'll move up 50 cents, which would be 100% in return. Gamma just pretty much goes along with delta, but delta and gamma you don't really have to pay attention to. That's not really anything that's important when it comes to the Greeks. The most important one is theta, time decay. So on most stocks you have weekly contracts, right? For every day, and they expire on Friday, every Friday. So for every day you hold that contract, it loses value, and it's losing value by the hour, right? So the longer you hold it, the less value is gonna hold itself. You know, it could get closer to, say, for example, Apple's at 195, and you think it's gonna go to 200. You buy calls on Monday, and it starts going up. It starts going your way. It's at like 196, and then, you know, you're in profit. It comes back down a little bit. You might be in the red, even if it doesn't go back down to where you entered, right? You'd expect that to be your break-even point. But because of theta and time decay, it's eating up the money or the value of your contracts the longer you hold. So whenever you see profit, it's always good to scale out a majority of your position. You might see drawdown even when you enter trades, but you know, once you see profit 10-15%, you always want to scale out a majority of your position, because if not, then you're not using proper risk management. We'll get into all that, whatever. But yeah, theta is really important. Do you trade every imbalance you see? What confluences do you consider before trading an imbalance you see? I'll show you. But first, let me start from the very beginning. Let me start from the basics, and then I'll get into how I trade on a daily basis. I promise you that this stuff here is very important, because you have to know the overall structure of the market. If you don't know what's going on, how are you gonna know like what's more favorable to trade, right? So obviously we're in an uptrend. We don't want to short it. Everyone's been trying to short it up here, and they got bagged every single time. They had one good day yesterday, and they tried to today. I mean, I shorted today. I made some money, but you're obviously never gonna get the move that you expect. Like, yesterday was unpredictable. It happened in the middle of the day. It died. Something happened. I thought I thought the president got assassinated or something. Like, that shit was crazy. You don't really see that too often. But now, since we have our weekly highs marked, we can erase these because we've already broken past those. And we can start marking these previous weekly highs here. Boom. Boom. I'll leave this one there. So now we use these highs, because these were previous, sell-off points, and we just ripped through those. So those are really strong levels, turn into buy levels. Now we go into smaller time frames. We try to figure out what's going on. Here we have a huge 1 4-hour sell-off candle. Like, that shit is crazy. But now that we've, figured out the trend, we figured out which way we're going, it's a lot easier to understand which way we're supposed to be trading, right? So all the way up, we're just trading the upside, 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 upside. All I do is I'll go into the 15-minute or smaller time frames, like the 5-minute, and I wait for price to make a move. Once price makes a move, then I'm ready. This is what I trade on a daily basis. So with the 15-minute, you obviously want to use like 1 to 2, 3-day contracts. You don't ever want to use anything less than that on a 15-minute, because the larger the time frame, the stronger the levels are going to be, and the longer it's going to take for them to play out, right? But here, what do you guys see? If you would have woke up late, say on November 14th, and you're like, damn, I missed the trade, I missed the whole move. No, you didn't. You want to wait for the move to happen. You don't want to just trade market open, jump into a trade, and be like, yeah, and then get bagged because you don't know what the hell's going on. You want to wait, because even though we're uptrending, we could also have days where, we come down a little bit, and you might be like, oh, I thought we were going up. It's because you're impatient. Just wait for the market to tell you what it wants to do, and then follow, right? But here we have an imbalance. This happens when buyers or sellers are in control of one another. So here, there wasn't enough sellers for them to, try to bring it back down, because if there are more sellers, there'd be red candles. But in this case, there's green candles, right? What happened here? It's based off 3 candles. So you have 1 candle, 2 candles, 3 candles. If this wick doesn't touch this candle, there's an imbalance there. There's no sellers there. It's just straight buyers. So this area here has a lot of orders that need to be filled. And what do banks do, or what do big money do? They will push the market higher to make people want to start buying up here, to have them selling it off to scare people, like, oh, should I buy it up here? Now it's going back down. This is how retail thinks. They know this is how, we as retail traders think. We're all retail traders. We're not hedge funds. We're not banks. We don't have hundreds of millions of dollars. But they know that people, they just jump in. Just like, you guys. You guys might see market open and be like, oh, just get in. They know you guys trade like that. So they'll move the market the way they want it. And then once they see people buying up here, they're going to start selling their position up here to everyone that is buying up here. Because for every buyer, there has to be a seller. For every seller, there has to be a buyer, correct? So they'll push the market up, and then retail makes the following move. They push it up even higher, and they're just selling their position right here. And then once they sell, start selling their position, they're gonna start buying more right here. So they might have bought like down here, or even lower because we gapped up like crazy, right? They might have bought like down here, push it up even higher, sold it off to everyone that's buying up there, and then bought lower. So they're gonna buy low, sell high, push it a little bit lower, buy low, sell high. Simple, right? Super simple. And that's all we have to do is follow big money. Because we don't want to be retail traders that just sit here and be like, oh, it's going up, I'm gonna buy, and then get bagged, and then sell. Buy high, sell low. You don't want to do that. You always want to wait for big money to show you that they're in the market. And this right here is a big money move. I guarantee you that if we all put all our money together into one bank account or into one trading account and started trying to move the market, that shit probably would not move 1 cent. I promise you. Well, it would move, but not like that. It's not going to move dollars. You have to have a lot of money to do that. Right? But you could take trades off these imbalances, right? How do you trade these? Now let's get into like risk to reward, risk management. What you want to do is you want to mark the beginning of that fair value gap. You want to set a stop right below. Sometimes you could go into smaller time frames and choose like a candle low to make your stop loss even tighter. So like below that candle low, now you have an even better risk to reward. And then it's as simple as, remember how I told you guys to target previous highs? This isn't an indicator. This is just a fair value gap. This is called price action. It's an imbalance. It's because there's no sellers to prevent buyers from just, ramping the market up. Remember when I showed you guys how to mark previous highs on larger time frames? You could do the same thing on smaller time frames. How we were using weekly highs to find the overall structure of the market. You could do the same thing on smaller time frames to find the overall structure of the market for the day. This is what smaller time frames are used for. Larger time frames are more just to see, all right, what's the market doing overall? Boom. How can you target previous highs when it's all-time high? Whenever the market goes back below all-time high, then you target previous highs. For example, pretend this right here is all-time high, 449.72. It was at all-time high up here, right? So you can't target previous highs. And then the market comes down a little bit. Now you could target previous highs. Boom. This is your take profit level there. This is a trade that you could take. And then obviously it ramped up, went crazy. You could have held it, held, and whatever. Welcome to a bull market. That's pretty much what's going to happen from now on. It's just going to retrace. We might have a few sell-off, and then I call it launch pads. Decrypt gang, we call it launch pads. Whenever the market starts selling off, we let everybody celebrate their bearish gains, and then we load up on calls and just let them shits run, and we bank. That's what's going to be happening. 2022, 2023 was probably the best time to learn because it was the hardest time to trade. It was just a bunch of sideways movement, bunch of crap price action. This recent price action, like November and December, first of all, they're notoriously like the most bullish months of the year. But it's been easy. You just buy calls. I'm not saying buy calls and then hold them and then you're going to be rich. That's not what I'm saying. But it's like pretty much feels like just buy calls and hold them until they go green. You know what I'm saying? Almost like contradicting myself, but I got to be careful because a lot of you will probably run into a trade and just be like, you know what, fuck it, I'm going to buy calls. But that's an imbalance there. Super simple. Let me go to today. A lot of you might be asking why did I trade puts this morning? So this morning I woke up kind of late, but this is why I love trading is because like you can wake up late and not even miss the move. You wait for the actual move to happen, and then you take trades based off of that, right? So this is what I saw this morning, right? I was live trading this, so I'm not just hopping on here and be like, oh, this is a trade that we could have like we actually took this trade and we made 100% off puts. Caught on live, alerted on Twitter, alerted on Discord, everything. But this is what I saw, right? So price was just moving sideways. We had to move down, we had to move up. So I was like, dang, what's gonna happen? And then I see this huge bearish engulfing candle. This happens when, there's no more buyers. It's just straight sellers and it engulfs this candle. Same thing can happen on a green candle, when it just completely engulfs a previous red candle you see here. But you always have to understand the current structure of the market. After yesterday, we're coming down, right? So there's heavy sellers. So for the moment, I know we're in an overall uptrend, but for the moment, I know that sellers are in control. So for today, puts might be the move. Shorts might be the move. Just understanding that price, is retracing a little bit or might retrace after climbing for 7 weeks in a row, right? But this is a 3-minute chart. I like to trade on like the 3-minute, 5-minute, just to give the market time to do its thing. And then once I see an imbalance somewhere, I'll take the trade. So everywhere here, I didn't really see an imbalance. You could have taken one here. There's an imbalance there in between that candle and that candle, right? And we ended up short or falling from there on a 1-minute. So this is still a trade here, right? But you'd only want to target previous lows. And to me, that's just not even really worth it. That's not that big of a move. But yesterday, we came straight down. You have a pre-market and aftermarket on your chart? I don't. But yesterday we came down. This is what pre-market and aftermarket looks like. Extended trading hours. Then you can see, but none of that really matters. The only thing that matters is intraday. Am I trading tomorrow? Yes, I will be trading tomorrow. I live trade every single day. No excuse. I'm there every single day. You guys have no excuse not to be there. 8:30 Central Time, 9:30 Eastern Time, and 6:30 Pacific Time, if you're wondering the time zones, because I know everybody's in different locations. But here we go. This is what I saw. I saw this bearish engulfing candle there. I marked this fair value gap, and I started entering shorts here. I said, if I don't, boom. This was later in the day, but if I don't get a candle close above my zone, you guys remember how I showed you how to mark your risk to reward? Boom. This is my stop loss there, right? If I don't get a candle close above that zone on whatever time frame I got in on, I'm not getting out the trade. And I targeted the gap right here. There was a gap fill because the market gapped up. That's what you call a gap. It's when price moves overnight. Boom. So I targeted the bottom of that gap. Obviously, we didn't fully hit it, but I was already pretty much fully out. Contracts were up like 115, 110% here, and then they were up even more there, but I was already fully out. How do you adjust to price action? I was amazing November, but December is sideways, bullish, and bearish. Yeah, you have to wait for price. Like you can tell when volume kicks in. Not every single fair value gap is gonna be valid, right? So there might be like fair value gaps up here. There's one. Look, there's one there. There's one there. There's one there. Like there's so many. How do you know which ones to play? You're gonna know just based off, price action. Price will literally tell you, and you can visibly see it when it's moving like crazy. You can see all these candles just like teetering. I wouldn't really even trust those fair value guys just because price is not, there's no volume. A lot of people say don't trade on news days. But let me get this in y'all's head, because a lot of people have the misconception that trading on news days is bad. News equals volume. Whenever, catalysts like FOMC, PMI, whatever it is, whenever there's news, those are the best days to trade because it's volume. The information that is given out to the public, for the markets, has nothing to do with us. We don't move the markets. Like I said, we follow big money. Big money are the people paying attention to the news, and they make their decisions based off what they hear, right? We make our decisions based off what big money does to their decisions of the news. Does that make sense? I know it's like a lot to unravel, but it's pretty simple once you get it down. We make our decisions based off what big money does to move the market after news, right? So when there's big news days, those are going to be the best days to trade. Today, I think there's pre-market news. There wasn't really intraday news, and we ended up getting a nice move, so it was pretty nice. Tomorrow, I don't know what news there is. It's in the Discord under market news, but we'll see. Another thing is I never trade intraday or intraday. I never trade fair value gaps that were created, the day before. So like, there's a fair value gap here, right? I'm not gonna trade this fair value gap. Tomorrow's a new day. I'm gonna wait for price to make its move because if there's no move, there's no trade, right? So if price moves, and this is just SPY, you can do this on every other stock, right? It works the same way. But if there's no move, there's no trade. So every day is a new day. Wait for price to tell you what it wants to do, and then you follow it. So you can have a bullish bias, but let's say volume kicks in, you follow it and trade their fair value gaps. Yeah. So, like I said, I've been bullish these last 6 months just because we've been uptrending. I've been saying don't short, don't short, don't short. But I don't have an ego, right? So it's like everyone has ego, of course, but it's like I'm not scared to be like, oh, we're coming down. I'm not just gonna keep going. We're gonna keep going up. I have to be right. I have to be right. And then it comes down a little bit and then continues to go up. And I'm like, I told you guys. Like, I'll never be like that because I'm a day trader first. Remember, I make money day trading. So I'm not just going to sit here and bullshit to try to, like, be right, to say I told you so. Like, that's not what real day traders do because we all want to make money, right? You got to be real with yourself. Say the wicks are tapping above the stop but don't close above. How do you stop yourself from closing it out of fear? By sizing in properly. So if you're in too heavy and you see it's about to hit your stop loss and you're worried about it, you're probably playing way too heavy. So just size down. Based on your rules, you wouldn't get taken out with the wicks go past your stop loss. No. If there's no candle close above my stop loss, I'm not worried about it. For one, that loss is so minimal that I probably wouldn't even lose much off of one trade. So look, I probably would have lost 10 to 15% after my entry if I got out on those wicks, right? I enter my trades with $1,000 each trade. That's like 100 to 150 bucks. To me, to a lot of people, that might seem like a lot. Everybody's risk is different, right? But to me, I'm not really like that. Doesn't really bother me. I know I've been trading for a long time. I understand how the market moves, how losses, whatever. You guys might be new to it, so like losses may affect the way you take your next trade. But even if I did get stopped out and it went against me, I'll just wait for it, the next fair value gap to the upside. If I was wrong and the market goes against me, I'll just play the upside, right? Because the risk to reward, the way risk to reward works is like it's just gonna, I'm gonna make my loss back and more. But I would have lost maybe like 10-15%. I think that was the lowest drawdown I saw. I also don't really, be staring at the position when I'm in it. I just watch the charts, and then it ended up going 100%. So that's like I don't even check what the ratio was on this, but it was probably crazy. I got money go out, yeah. I got money. Yeah, I appreciate the follows, man. Let's see. So 0.14 to the bottom of this gap. 0.14 to 21. Holy shit. So this isn't even like a, you know, a lot of people say 1 to 3, 1 to 4. Like this is a fucking point 14 to 21 risk to reward ratio. Like, do y'all understand how absurd that is? You know, rather than using whatever anybody else does, I just use highs and lows. That's it. And this is a gap here, so I use the bottom of this gap. That's an insane risk to reward. If you ask me, I'll take that a million times because I know that even if I lose half a million times, I can win maybe a couple, or I can make like, or I can win 100,000 of them and still be profitable using that type of risk to reward. That's, I mean, that's just risk to reward. That's the power of it. So, you mean AM and not PM? Yeah, probably. Okay, so you only get out of your position if the candle with close. Would you consider getting out if it decided to fill in the engulfing? Um, the only way I would get out if it hasn't closed yet is if I saw a candle like this, like how this candle completely, or let's see this engulfing candle to the upside. If I saw it just completely, you know, go up like crazy, I would be like, all right, I have to get out. Like I'm not gonna wait for it to wick back down and be like, oh, faked you out. Because price, you know, those days like where it go like comes down, you see volume, and then it just starts going back up. It's gonna be a sideways day. So those days I tend to stay away. But that's the only way I would get out if I just visibly saw the can like pushing through it, and not like if I see it like rejecting, then I'm like okay, like it's gonna come down. It's just when, you know what I mean. They're still tapping in orders, and then they bring it down. So it takes time, it takes patience, it takes a lot of um, experience in the market to understand like oh, okay, like I've seen this so many times before. It's like I'm not really worried about it. But the only way I would get out if it didn't close yet is if it goes crazy. Can you go over supply and demand? I can. Supply and demand is very similar to fair value gaps. Let me show you guys. So obviously with supply and demand, you always want to find the overall structure of the market, right? What candle was I using? I think I used a 4-hour fair value gap on this. But supply and demand is super easy. Let me show you guys. On supply and demand, I like using like the 15-minute, 30-minute, and pretty much it. But with supply and demand, you're looking for a rally, base rally. It looks like this. This is demand. Demand is up. You know, there's a lot of demand. People are buying. Supply is down. Where's this? Boom. So you have a rally there. You have a base, and then a rally, right? So we obviously have a lot of demand there. What I do is I'll mark the candle that started the move, like so. Boom. And then I simply just wait for price to come down and retrace. The way you would mark your risk to reward is you first of all you target previous highs, and then that candle low. Because this risk to reward just wouldn't make sense. I see people marking their risk to reward like that, and I'm like, bro, what is the point in that? Gotta keep your losses tight. This was like a 1 to 12 almost. And then supply, I'll show you guys what it looks like. But since we're like in an uptrending market, it's not really worth playing supply. Because on larger time frames, market's more than likely just gonna keep pushing up. Let me see if I can find supply. Boom. That's literally a perfect example there. But on a 4-hour time frame here, we have a drop, base, drop. It's literally the opposite of demand. It's supply, right? Get the candle that started the move. This candle here, boom, 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 boom. And look, we come up and touch supply, and it retraced. Boom. I've been looking at this. It looks so clear, but I didn't take this trade. I'm not gonna sit here and say I did. But that was like, supply and demand works really, really well. I'll tell you that. But yeah, I mean, as far as that goes, how they filled the gap. What do you mean? As far as that goes, that's basically pretty much it. There's not really much else to it. If you missed a couple things, I'm gonna post this on YouTube, so feel free to go watch that as many times as you want. I have several other videos there too. And then if you want to join the live trading, premium is closing December 31st because I'm starting the mentorship in January. Right now it's currently 20% off, and it's probably going to be the cheapest it's ever been. So take advantage. Do not miss out. Don't be those people that like, oh, fucking, I don't know if it'll work. Bro, trust me. Just fucking join. That's all I'm going to say. I live trade every single day. It's hard to be a cap trader when you have to live trade every single day and be consistent every single day. You know what I mean? That's all I can say. But yo, it's been Decrypt. I appreciate every single one of you that came in here to try to learn, asking me questions. I promise you, I'm going to get every single one of you right. If you have any more questions, ask away. What is your criteria for marking? It's really just, to see the overall structure of the market. That's it. I don't really use it for anything else, so like if I see that we're in a downtrend, I'm gonna mark previous lows and target those, right? If we're in an uptrend, I'm gonna target previous highs. Once we start breaking those highs, I target the next high. Simple as that. When I start the Discord, I started it in 2020. My place looks toasty. I'm actually getting a new apartment. I'm gonna. I won't say too much. I won't say too much, but I'm getting a new place, and it's a lot bigger and it's a lot nicer. But yeah, I appreciate every single one of you guys hopping in here. I'm gonna try to do one of these every single week um, after January. Like I said, premium is closing. Take advantage. Join. 20% off. Use code EOY for end of year. EOY. Get 20% off at checkout. Join up. Live check every single day. Let's get to it, baby. I'm going to post this on YouTube. You guys take care, man. I'm out of here. I appreciate y'all.